Hi everyone, welcome tonight to the session. Thank you very much for coming along to this session on ESG and FinTech. We're delighted obviously to be hosting this latest event in the FinTech-Tables series, which is itself based on the FinTech Scotland roadmap. And the roadmap's got 4 key components, and climate finance is one of them, and we've already held some successful events on financial regulation and also on payments. This one's the latest, and there will be one to come on open finance. My name's Yvonne Dunn. I'm a partner here at Pinsent Masons. My focus is particularly on financial technology and FinTech, and I also lead our firm's engagement with FinTech Scotland. And at Pinsent Masons, we focus on climate and sustainability. We advise clients across the spectrum of climate and ESG related matters, and we also have, as part of our proposition, the Sustainable Finance Consultancy Morgan Green, which Hayden leads, and you'll hear more from him shortly. We've developed propositions that are specifically targeted at fintechs, focusing on supporting fintechs to get in place a sustainability policy and have consultancy services around that, and any of the team are very happy to talk more to you about that after the session. We've got a great panel here tonight, and I'm going to get them to introduce themselves very shortly and discuss the topic. I guess, though, just before that, to set the scene, because ESG is just such a huge topic, and the FinTech Scotland roadmap focuses on climate finance. And it rightly identifies the impact of climate change is disrupting economies, it's disrupting lives, and it requires urgent action from everyone to address it. And as well as climate, we will, though, tonight focus on broader sustainability issues. It's quite hard not to, because these issues do all merge. This is an issue that affects all businesses and all sectors, but we believe that fintech's got a key role to play in relation to sustainability. So we're going to focus the session in 2 key areas. First of all, we're going to look at where there are drivers for fintech businesses to make themselves more attractive from a sustainability point of view. And by that, I'm thinking about attracting customers, attracting investors. And secondly, we're going to pivot and look at how ESG and sustainability represents an opportunity for fintech businesses to create and market products and services. So in terms of the format, we're going to kick off just by getting each of the panelists to give us a short introduction to themselves and their connection to tonight, and then we'll get into some questions and discussion. I've got plenty to ask the panelists, of course, but unfortunately it's not all about me, and so very much keen to hear from you as well. You'll see on the screen there is a Slido number there. If you have access to Slido, you'll be able to log in and put your questions on there. I'll see them up here and I'll put them to the panel, as well as some of the things that I was keen to ask them as well. So without further ado, I will pass over to the panel for intros. Hayden, I'll maybe start with you, since you're closest to me here, and we can go from there.
Thanks Yvonne. Hi everyone. Yeah, my name's Hayden Morgan. I'm a partner here at Pinsent Masons and head of Sustainable Finance Consulting, which is part of the climate and sustainability team. Relatively newly joined. I've been here 4 months, previously with a firm called Morgan Green Advisory, as Yvonne said, which was acquired by Pinsent Masons start of the year. We were very much focused on consulting and professional advisory for financial services, so integration of sustainability and ESG into operations, activities, products and services, and enhancing performance, reducing risk, and also sort of accessing market opportunities as well. I'm really keen today to focus on that opportunity piece and the role that FinTech can play in meeting some of these sort of needs for clients as we transition to a lower carbon, more sustainable economy. A little bit of background of my experience. I've been working in sustainability now for over 25 years, and a lot of that has been with financial services companies and organisations. So I've seen really full circle from being sort of locked away in a cupboard somewhere when we first started out to sort of being now brought at the boardroom and, you know, being really core to this transition around sort of integration in terms of strategy, risk management, metrics and targets, which again is another key focus, I think, for FinTech, and around disclosure as well. There's a whole bunch of, and we call it a maelstrom of disclosure requirements coming down the line. I think there is also a role there for FinTech to help organisations respond to this regulatory compliance maelstrom, as we're calling it, in terms of getting asset level data right through to investment managers, right through to the sort of institutional owners, and the role that FinTech can play in responding to that, and the various market opportunities, as I mentioned earlier. So really, really keen to explore that as well. We focus on, in the consulting elements, I'm not a lawyer myself, but we focus much more around the sort of implications of legal and compliance regulatory drivers, and what that means for implementation for clients. So how to sort of take the requirements and then implement that, like I said, in the activities and the operations of firms, but also very much also around products and services as well. So how can firms respond to this global transition, which is pretty much affecting every sector globally. So it's a huge opportunity. Not dismissing the risk, I think, but a lot of the time there's a lot of commentary around the sort of risk element. It's more the opportunity I'm quite keen to focus on. So if you've got any sort of ideas around that, feel free to stick them in the Slido, and really keen to sort of thrash those about. Thanks, Yvonne.
Okay, great. Thanks, Ian.
Thanks, Yvonne. I'm Ewan McVicker. I'm a Senior Climate Advisor here at Vincent-Masons, which is sort of a new role that we have developed over the last couple of years. I'm the first Senior Climate Advisor, but I hope to be one of many performing that role as we develop the business. I am a lawyer, and I am looking at the legal consequences of the climate and sustainability issues and the governance and reporting and disclosure issues that Hayden's been talking about, and work very closely with Hayden's team in giving both a kind of legal and a broader commercial and practical view as to how these issues can be dealt with in businesses across a variety of different sectors. My own background is within energy, and it was working on energy projects where I really became engaged around the issues around the energy transition and understanding the importance of dealing with the climate emergency. And I was an energy partner here at the firm until 2013, when I went to join the Green Investment Bank, where I worked closely with Hayden, who was there as well, working in a financial services company, helping to sort of deliver green infrastructure projects of various sorts, and reporting on the green impact of those projects as a very kind of early green impact investor, looking at reporting on the positive impact that our projects were having, reporting on that to the market in just the same way as our financials. Hayden's talked about this maelstrom of legislation and regulation that we're seeing coming down the line. And one of the things I think is particularly interesting for the fintech sector at the moment is that we're seeing globally broad alignment across various different types of organisation, different jurisdictions about the direction of travel, but with some key differences in some areas. But everyone is being pulled along to the highest standard in many ways, because many of these different jurisdictions are implying standards that will apply to the companies that are based and subject to that regulation, regardless of where their physical operations are. And so we see that in particular in relation to some EU regulation, which has extraterritorial effect. And so for people dealing with large financial services customers within the EU, even though they might not be based there, they're going to have to grapple with some of these issues. So that growing internationalization, yeah, is that right? Internationalization of these issues is a key thing that I think does give rise to increased compliance risks, but also, as Hayden says, opportunity. So there's lots to discuss on that front today as well. I'll hand over to Jules.
Thanks, Ian. I'm Jules Salmond. I'm a CEO of a company called C&DOS, and we sit between climate tech and fintech. We are predominantly looking at utilising financial services, tier one banks, to unlock SME climate data. So we are focused on a just transition, ensuring that all SMEs, whether you're micro businesses right up to tier one corporates have access and to the ability to understand their carbon footprint, but also to be able to access the finance and the financial flows to allow the transition. So we are currently working with a number of Tier 1 banks here in the UK and across Europe to unlock and share carbon emissions for SMEs in the supply chain. So kind of my background, I'm not a lawyer, but we had a previous business with Pinsent-Masons in the RegTech field. So we worked in third-party risk, which was dealing with very complex international supply chains. And that was predominantly around everything from anti-bribing, corruption, human trafficking, modern slavery, and there was elements of ESG in there. So my kind of interest in the ESG side really peaked where we were working with a number of FMCG companies, a number of West Coast tech companies who had very complex international supply chains in the millions of third and fourth parties, and they were asking on a regular basis where at that point we'd actually sold our business to Dow Jones, so worked for one of the biggest kind of international data companies, and they kept asking us, you must have data on our supply chains. So did a bit of digging, we found a data set in the Dow Jones business that we had, and it had 15,000 companies. And I couldn't take 15,000 companies to my client who was looking for 4 million companies. So after a number of kind of months trying to kind of crack that nut, we decided that actually it wasn't right to do it within a large corporate. We had to do it in a more agile way. So that's where we've ended up in CNDOS. So I'm really hopefully going to be focusing today on the opportunities for SMEs and how SMEs and fintechs are really, really well placed to take advantage both from a talent attraction, finance funding attraction, but also from the market opportunities.
Hi everyone, Andrew Davidson. I'm an investment director in the team at Scottish Equity Partners, and at SEP we are software investors focused on growth equity. So SEP's been around since the year 2000, so we're a long established player in the European tech investing ecosystem, and during that time we've transitioned from earlier stage venture businesses into a mix of venture and growth, and now focused on growth. And what that means is that the companies have typically found product market fit and they're looking to scale up. So our capital is used both as a primary investment that goes onto the company's balance sheet to help that company to accelerate growth wherever they think that's appropriate, but then to sales and marketing, opening international offices, investing in R&D, and it can also be a secondary capital investment, which is maybe tidying up the cap table or de-risking the founders. We focus on 3 core sectors. Financial services is one of the 3 core sectors, along with life sciences, software and industrials. And there are lots of very good, interesting businesses within Europe, and particularly in the UK, and particularly in Scotland, in the fintech ecosystem. So we're looking to meet those businesses roughly at the point at which there are probably about 50 people. So that's roughly where we start to invest, and fintech's a key area for us. And then in terms of ESG, we take it very seriously as a private equity house. We are signatories to the UN's Principles for Responsible Investment, and with that entails a lot of activity throughout the firm and across the portfolio to make sure that we are promoting ESG and sustainability as the companies scale, and we find that helping those companies to build that infrastructure really helps them as they scale up to much bigger businesses, from 50 people up to 250 people.
Fantastic, thank you. That's great. Well, great to have you all along tonight, and good to have a mix of skills and interests and backgrounds here. So, if we're going to focus initially just on, what are the drivers for fintech businesses, particularly in this ESG and sustainability space? I think let's open that question. So maybe we can kick off with you, Ewan. Just thinking about what the main ESG, regulatory, legislative, other drivers are for financial services, and then specifically for fintech.
Yeah, sure. So I think the first point to note is there's an increasing amount of legislation and regulation that's affecting the financial services sector, both within the UK and more broadly. And perhaps the second point to note is that generally speaking, when legislative and regulatory requirements are introduced, they are introduced to hit the financial services sector first of all before being rolled out to the rest of the economy. So we've seen the financial services sector being a bit of a test bed for legislation and regulation in this space, but also perhaps to some extent being seen as a bit of a policeman for governments in relation to policy in this area, the thinking being that if you can require those people that control the funding to be subject to rules around how they deploy that and how they report on how they're deploying it, that will change behaviours throughout the economy. And so it continues to be the case that when it comes to most new regulation, it's affecting the financial services sector first of all, and certainly to an enhanced level. So what are some of the key pieces of regulation or regulation that we're seeing that are affecting behaviours? Well, the first thing is that people who are subject to varying degrees of financial services regulation, particularly large asset managers, banks, insurance companies, very large pension schemes, are subject to a series of rules from the FCA under their ESG rule book, and that requires compliance with something called the Task Force for Climate-Related Financial Disclosures, which was a initiative created by the G20 to try and get a standardised way of approaching reporting on climate issues. And that requires companies to disclose around how they are dealing with governance of climate-related issues, how climate is affecting their strategy and how they build that into their strategic decision-making, how their risk management systems reflect climate issues, and what targets and metrics they've got in place as a business to deal with these risks associated with climate. And that started off as a voluntary initiative, but it's become increasingly mandatory. So the largest financial services regulated entities have been subject to that for over a year now, but this is the first year we're seeing that being rolled out more broadly across the economy, with other large businesses and premium listed companies being subject to that reporting. And that's been very influential. It's requiring a lot of detail about how people engage with their supply chain, how they think about their business relationships and their strategy going forward. And it's changing and morphing as people get more used to the reporting cycles on that. And I'll just note that coming fast down the track, there's something else called the TNFD, the Task Force for Nature-Related Financial Disclosures. And we're now in a kind of final beta testing phase of that, and that's expected to be introduced on a mandatory basis within the next few years. And the UK government's been pushing that quite hard as something that's coming down the track. So that's something to keep on top of. The FCA also requires companies to publish transition plans, which detail how people are actually going to put what they're saying about climate issues into practice. And that's now being enhanced by the work of a transition plan task force that UK government set up last year, which reported earlier last year and is now consulting on its initial findings. But that's looking at being a 3-yearly cycle of how you're going to meet your transition goals, and annual reporting to support that. And it requires people to look at setting their ambition, setting out publicly how they take action and what sort of actions on a granular basis they're going to take, and how they make themselves accountable to stakeholders in relation to that. And I think that's got the ability to be quite determinative of people's approach and create quite a lot of real action and impetus in this space, but it's going to require a lot of support and a lot of backup for people to be able to deliver on that. And another FCA thing that I'll mention and we'll maybe come back to is the fact that the FCA for these larger players requires people to report on their climate value at risk. So how is their asset base being affected by climate risk? How do you put a number on that? And that's something which I think we might come back and look at in the implementation phase as being an area of opportunity. And there are other wider things I'd like to point to out with the UK. So in Europe, there's a suite of very important directives and proposals. One is the Sustainable Finance Reporting Directive, which is very important to the fund management industry, and that requires people who are setting out marketing funds which have got a particular green angle to them. They're being classed as a particular type of green fund to adhere to particular requirements. And there's a lot of change going on in that space just now. The UK is looking at introducing its own equivalents to those rules for UK fund managers. And we also have the EU Corporate Sustainable Reporting Directive, so many acronyms in this space. That has come into effect, is now binding on EU, but has extraterritorial jurisdiction, as I was mentioning earlier. And that requires companies to report on an annual basis on climate, biodiversity, impact on nature, use of resources, and also on a variety of social matters as well. And that's going to be a really significant piece. It's going to be rolled out across companies that are affected. But I think the global impact of compliance on companies is going to be huge, because it's going to require people to be asking for data and information from right across their value chains and having to aggregate that and bring it together to put into the reports. So that's potentially going to be huge. And the final thing that I'll mention for just now is another European directive, the Corporate Sustainability Due Diligence Directive. And that's just passed an important hurdle last week. It's now going on to the legal committee of the EU for the next stage. But that puts a duty on affected businesses to identify, end, prevent, and account for human rights and environmental harms within their own operations and across the whole of their value chain. Now that's a massive legal duty to be imposed on companies, and people are still grappling with what that might mean. And that's maybe a point to leave that.
Okay,
what does that mean for fintech businesses? Well, there's a couple of things. As borrowers and investees, all these financial services companies are going to be thinking about where they're allocating their money as they're sort of subject to these enhanced reporting requirements. So if you're looking to raise debt, or you're looking to get equity investment from an institutional investor, you're going to have to think about how to be attractive and how you're going to provide the data that they're looking for. Also, if financial services is your customer base, you need to be able to compete on a basis which shows you're going to be able to give them the information that they need and provide them with something useful, and you're going to help them comply with their obligations. And finally, it's a really rich hunting source of opportunities. There is so much opportunity to meet the needs that these directives and regulations are coming up with, that there is all sorts of scope for entrepreneurial businesses to respond to.
Yeah, absolutely. And, I think with so much of what we talk about in financial services, legislation and regulation is such a key driver, and as you've outlined, Ewan. And I suppose it links to what one of the last things you were just saying there, but Andrea, I was interested to move beyond, for now, legislation and regulation as a driver and more think about investment as a driver. And, thinking about it from your side as a private equity investor, what would you look for from a sort of ESG or sustainability perspective if you were thinking about investing in a fintech business?
Yes, yeah, that's it's a good question, and actually in terms of fintech or other software companies in different sectors, we have we don't have an expectation that the companies that we're investing in will be the finished article in terms of how they deal with ESG and sustainability. It's very much, we're not sustainability investors per se, and we don't expect that has been an absolute central focus for lots of the businesses. So if you're an insurance broking platform, then you're typically focusing all your energy on growing the business. So what private equity does and what SEP does is, I think, help you to build out the infrastructure to then think about ESG on a more formal basis, And I mentioned that SEP are very focused on ESG as investors, and we've actually built out our own framework around how we think about ESG, which has been tailored to focus on the software companies at the scale-up stage that we're investing in, and this is certainly encompassing fintechs as part of that. And our focus is very much on governance and culture and society. So actually, interestingly, it's slightly less of a focus on environmental. We do obviously think that's important, but for software businesses that we're backing, they're asset light. Their impact on the environment tends to be lower. So compared to a private equity house who's investing in an industrials or manufacturing business, the impact on the environment is not as great. Therefore, it's definitely something for us to consider, but not as important as governance and culture in particular, where we focus. So maybe just to touch on those governance and culture points, if I may. So governance is very much an area that private equity has majored on for a long time, and this is things like, just to give you an example, having a board in place and making sure that board is independent with non-executive director and a chairman. Again, often the companies that we're investing in don't have a board in place, and we help to build that board. So that's some of the structure that we bring. Financial controls, making sure that the company has appropriate financial controls in place. Is there an FD? How qualified is the FD? What's the size of the finance team? How do they go about producing quality financial information, reporting? So what KPIs does the business track, and how is it using that data to improve productivity within the business? Again, we see a mixture of some businesses that are really first class in terms of financial controls and reporting, and others that have got a great business and it's growing really well, but it's slightly out of control in the way that it's growing, and it needs some financial control and rigor. And then how does the company think about risk is the final point on governance. So is it operating in a regulatory environment, of which lots of fintechs are, for example, a payments business, and how does it manage the regulatory environment and dealing with that? So governance is absolutely key for us, and then culture is the next big one. We're minority investors, and partnership is a very important factor for us. So we need to make sure that our culture at SEP aligns with the culture of the company that we're investing in. So there's that important factor there in terms of a working relationship between a company and an investor. But also with software companies, there's been a huge battle for talent over the last 5 or so years, and culture is a way that you can attract and retain talent on a permanent basis. So we really look for companies that have strong culture and put in place. There's lots of, throughout our portfolio, lots of different novel and different approaches about how to go about enhancing the culture of the organisation. And I think at the stage at which we're investing, we like to see it as being more than simply talking about having a good culture, but actually demonstrating things that you do. Be that communication with the team in terms of town halls or taking surveys amongst the staff, or learning and development. What's your approach to that? Culture is an absolute key. So I think that in terms of the most important, governance and culture for SEP is a key ESG consideration.
No, that's fantastic. That's great to hear. And there's some interesting questions coming through on the Slido as well that link to some of the points that you've been making. There's actually one that I wondered, Jules, if I might raise with you, because it relates to supply chain, and it's an area obviously that's you've talked about. And the question is just how mature do we feel businesses are assessing ESG risk in the supply chain? Are you seeing firms doing deeper due diligence? Do you see de-risking around that? Any thoughts on that, Jules, from what you're saying?
I think there's certain, horses for courses, I think there's certain businesses that are doing a very good job. I think businesses that have slightly deeper pockets, that are kind of in what we refer to in our business as a kind of top 1%, who can invest in your professional services teams, have ESG software solutions in place. they're much better positioned to have that interfacing into their kind of third-party due diligence piece. I think the challenge is as soon as you come kind of to the next level down, your mid-market and your kind of smaller businesses, there's an element of what questions do we need to ask. The whole question around materiality is a real challenge, because do you do your materiality analysis on spend? But actually, in traditional risk world, so the world that I was in before, your risk was a multiple things. So where are you operating? What jurisdiction are you operating in? And so on and so forth. But in ESG, what is your materiality? Is the E more important than the S, more important than the G? So I think all these questions are very difficult to answer. So I think back to what Andrew said, is focus on what of the ES and G is the most impactful element of your business. So if you're in a software business, it's more probably around your S and your G. Most software companies use cloud services. They can access the E piece relatively easily. They know what their energy usage is. They know what their business travel is. So focusing on what you can understand is probably the most important thing. And as Andrew said, having the data available for when someone comes and asks the question. But yeah, I'm not sure I answered the question.
No, it's
properly, but
I think you're right about that focus. It is, as we said at the beginning, it's a big old topic, so you've got to sort of work out where you want to play in that. That makes sense. And another question that's come in from the floor, and Hayden, I think this is probably in your bag, is the statement, which I think we can probably agree with, that the regulations are complicated. I think the question is, what can the fintech business do to build their understanding so that they can actually come to advisors like us and ask the right questions and actually respond to this complex landscape?
It's a tricky one, to be honest. I mean, and just to add to some of Ewan's comments there's additional regulation, which I won't go into detail now, but it does impact, as we were talking, supply chain. So there is a requirement, for example, under the EU taxonomy, to go through your suppliers and get yourselves comfortable with their human rights, modern slavery, right down to potentially the sort of absolute sort of almost to the mine, where stuff's mined, factories where it's put together in China, and we're seeing clients come to us around that. But in terms of, keeping abreast of this, it is challenging. We've got a service, and others are available around horizon scanning, which looks at this incoming legislation and puts it into the context of your business, and also not only from a compliance perspective, but also from a stakeholder sort of expectation, which is equally important. I think if you're not captured directly by the regulation, then there almost certainly will be stakeholders that either will be captured or have different and similar expectations. And it is quite a complex sort of moving, dynamic environment. That being said, there are some sort of commonalities around some of these requirements, not least for sort of fintech. Data is a common one, and GHG emissions and energy use, again, is probably material for fintech organisations. I should just say on the data piece, that from my perspective is a huge opportunity for fintech, because all these compliance requirements are going to generate vast amounts of data. This is unstructured data. It's sort of semi-quantified or quantified. There's a lot of qualitative data that still needs to be organised, and aggregated, validated, and disclosed, whether for your organisation or for your potential clients. So from my perspective, there's a huge opportunity here. There is a sort of growing mini industry of providers out there, but even then, they're still relying on others to input the data, others to sort of, they may aggregate the data, but to make sense of it. So again, it may touch on some of the aspects around the opportunity, but is there sort of opportunity there to structure some of this data, provide machine learning? It's going to be an explosion in terms of not only from a climate perspective, so you've got, your GHG emissions, you've got your climate risk, and climate risk itself can be broken down to transition, physical, legal, whatever else. But also the broader sustainability, so you've got all the social aspects of it as well. You've got the broader environmental, biodiversity, resource use, water, all the circular economy stuff. It's just going to be such a sort of complex, like I say, sort of data-driven environment we're moving into now.
And I mean, just and I suppose on that, just also, I mean, as we are sort of blending into opportunity as well, which is helpful. I mean, Ewan and maybe Jules, I don't know, do you have views just like as Hayden's identifying where we can turn this kind of threat into an opportunity from a fintech point of view? The complexity actually creates opportunity.
Yeah, I think in terms of the opportunities that we've got, I think the key thing is to understand, particularly if you're an existing fintech that has products and services that are already out in the market. I think it's different if you're coming into the market like we did. We saw an opportunity before we were kind of in the market. I think if you're an existing fintech, it's understanding this maelstrom of regulation and legislation and working out which of that impacts me, which of it impacts the customers I serve, what jurisdictions am I operating in or wanting to operate in, and then whether you come and speak to Hayden or as Hayden has other services out there, but trying to identify, right, I need to understand the CSRD, I need to understand PCAF, I need to understand, they're all 4-letter acronyms, which is a nightmare. But first of all, identify what of this spaghetti junction regulation do I need to understand is the kind of the first thing. And then what products or services can I offer that will help my customers adhere to those regulations? So is there something that I can offer that's adjacent in an adjacent market to the products that I've already got? So rather than trying to reinvent the wheel of the products and services you have, it's saying what products and services do I have already, what data do I have already, and how can I shift that slightly and focus it more to service the regulation and the jurisdictions that I need to serve.
Yeah.
I think that's probably kind of the biggest opportunity.
Yeah, absolutely.
Yeah, I mean that makes sense. I think that the pressure to get good quality data on those higher up in value chains is only going to grow and increase. So people that can find ways of providing good quality data can use that as a competitive advantage. I think there's also opportunity around looking at some of the intersectional pieces around, yes, we've got climate drivers, but there's biodiversity and there's social drivers. People are finding it very difficult to make good informed decisions on how to do trade-offs between those areas where they start to conflict. And that is something that does happen. Not everything is good for all of those areas. So products and services that can help deal with some of that intersectionality, I think there's a lot of opportunity around that. And there's a lot of opportunity around risk management, I think. We talked earlier about things like the climate value at risk and helping to really track where a company's real risks are and help them deliver on managing those risks in a meaningful way is another area of opportunity. Those would be the areas I would focus in on.
Yeah, no, that makes a lot of sense. And there's a couple of questions coming through just for you, Andrew, just in terms of how you're looking at things. I mean, one question would be, do you, in your opinion, are the majority of PE houses adopting the same approach and concentrating more on the S and G, but not the E? And it's not, I won't ask you this question, but there is an interesting related point about reconciling some of the technology like blockchain, etc., with and the energy that consumes with ESG values.
Mm-hmm.
But yeah, so what's your thoughts on either both of those?
So yeah, firstly, in terms of other private equity houses having the same approach, our approach is tailored to the software companies that we're investing in, and others may well have a different focus. We spent a lot of time within SEP developing that framework. We have a cross-departmental team who focuses on ESG and think about this on a regular basis. That includes representation from the legal team, from the LP, so the fundraising team, from the portfolio team, and from the new investment team. So we worked across the company with a consultant to develop that framework. But it's not rocket science, and I suspect other software investors would have the same areas of focus. The potential greater emphasis on environmental, I think, is an interesting one, and for potentially if you are, say, focused on payments, or if you focus on blockchain, and that obviously has a bigger environmental impact, then you will need to factor that into your thinking. And for reference, the driver behind all private equity houses is that the people that we're getting our money from, our investors, have ESG requirements themselves. And for example, lots of our investors are pension funds, and the people who put their money into the pension funds understandably want to make sure that that money has been invested into companies that are doing good for society, rather than ones that are making a good return at any cost. And there's been a huge shift in the market to focus on that, particularly over the last five or so years. So we are we're under under pressure. There is a certain expectation that we are investing responsibly and have a focus on ESG, and that's driven by our investor base, and that will be very similar for lots of other competing PE houses.
Yeah, no, that makes sense. Yeah. And just sort of, since we're in the opportunity side of things, I mean, Hayden, just to come back to you, I think, thinking about opportunities for fintechs, more specific opportunities in this space. So in the emissions space, would you see there being a role for fintech solutions there? Is this a space they can play in and try to improve?
Yeah, absolutely. I mean, we talked in terms of that supply chain and what we call scope 3, which is not your direct emissions, but your supply chain emissions, or your value chain emissions, basically. And I think they're absolutely, in terms of collecting data or providing a product potentially, which you could offer corporates or even financial services, in terms of leveraging a data platform whereby suppliers basically can upload their data, is validated, you can then offer that as part of that whole sort of value chain reporting. This is going to be really important, actually, especially when transition plans we mentioned come into play as well, because in the value chain, those at the bottom of the sort of pyramid, if you can imagine it like that, their disclosures will be relied on the next tier, which will be relied on the next tier. So it sort of all builds up. So the accuracy of data, and especially greenhouse gas emissions, is absolutely critical here. And a firm's scope 1 emissions in the sort of lower parts of the value chain are scope 3 emissions as you go up. So it's really important to get accurate GHG, greenhouse gas emissions data, and a fintech solution could be absolutely ideal for this. And then if you overlay that with all the other data points, just a bit of a sort of reference point. We was on the phone yesterday with a client, and they were talking around all the different sort of metrics that they collect, and it's somewhere in the region of 2,300 separate metrics that they have got to keep tabs on effectively within their organisation, which includes their investment management and their asset management activities. So you can see there's a huge potential there, and this is regulatory driven as well. So this is not going away. This is not nice to have. Firms will have to comply with this and will have to demonstrate. Transparency is crucial as well, as is validation and ensuring the quality and robustness of that data. And I think just one step ahead, sort of, not only is this like I say, the maelstrom, you've got the data growth and explosion there, opportunities for things like, again, it's not my area of expertise, but things like, machine learning. How do you make sense of this data? To Ewan's point, there's a lot of sort of interfaces, and how can we use technology to understand the interplay between all the different metrics? Because ultimately, we're trying to move towards a more sustainable, lower carbon economy and transitioning business models. Where are the key sort of pinch points in terms of, the most impact we can have for the sort of minimum amounts of investment? And understanding that from a data perspective, I think is going to be really interesting when we start to apply some of these more advanced data processing models.
Yeah, absolutely. So there's the specific areas where fintech can play, and I guess then to turn it around a different way is there something in fintech by its very nature as opposed to more traditional businesses? And Jules, I was struck by what you were saying when you were introducing the business about how you felt that what you wanted to do was something that you wouldn't be able to achieve within the large organisation, and you needed that a bit more agility to do it. And I suppose I'd be interested in your view as to whether fintechs, by their nature, have got an advantage. And there's a question, that we've got here around this actually about, how much of an advantage is it for fintechs over the kind of top-tier traditional financial organisations, that agility in the context of ESG? What's your perception?
I mean, I think as fintechs, we are at the very kind of forefront of the transition. So exactly what Hayden or Ewan said earlier on, that rightly or wrongly, governments tend to put regulation onto financial services first. Banks love it, and the financial sector loves it. But that, as a result, as we are servicing that industry, the financial flows that are required in order to finance the transition is ultimately coming through fintech. So we are at kind of the right position to be able to service those needs. So from a purely business to business perspective, we've got the opportunities basically at hand, because most of us work in a regulated environment already. We're already in that space. We already have the connections within the financial services industry. In terms of the kind of size and the age of most fintech businesses, most of them are kind of less than 10 years old. So from a structural infrastructure perspective, we don't have a lot of legacy kind of technical debt. So therefore we can utilise cloud services. Cloud services have very good ESG components. Most of the large service providers, Microsoft, AWS, and so on and so forth. So we're able to procure services from kind of carbon and ESG aware businesses. We've got the ability as kind of leaders within fintechs tend to have relatively flat organisation structures. So we've got the ability to lead by example, to take and say, actually, we want to be socially inclusive. We want to have a diverse leadership team. We want to be kind of nature loss and climate focused and aware. And I think if we take that as leaders of fintechs and make sure that is kind of infiltrating down the businesses, I think that's really key. But it also helps to attract finance. So all fintechs need finance. It helps us to attract talent, which most people in this room will know that's very hard to come by and has been over the last couple of years. But it's also really important when you're starting to look at your board and your non-execs. That was something that we've been, because we've kind of been down this road already, we knew that was actually very important to have a really diverse board, have a socially inclusive board as well. So that's something that's been at the forefront of us. So I think both from a business to business relationship perspective and the market we're in is a really good opportunity, but also from the size and age of our businesses, I think we should really be at the kind of at the top of the chain for that.
Yeah, and it's interesting because one of the things we talk about in fintech generally, not necessarily in this context, is that balance between fintechs have got that agility and fleet can be more fleet of foot perhaps than some of the more established players. On the other side of the coin, though, there's this sort of trust and brand and all of those things. But I just wonder whether, because this is such a new and emerging area, I wonder if that kind of traditional trust and brand thing is perhaps less important, as in people are just, this is brand new, let's just look at the solution as it is, and maybe that gives you the opportunity, I don't know, but it's something we certainly see coming up across fintech generally.
Yeah, I think from our perspective, I think you have the same. It's not any different to any other, particularly in the B2B market. It's not any different. You've still got the same barriers to entry as a fintech into kind of the large traditional financial services, because financial services are under so much regulatory scrutiny.
Yeah.
they like to go with the bigger brands
Sure.
and the trusted partners.
Yeah.
So that's an age-old challenge.
Yeah.
So
And that's another topic.
That's it.
One that we often talk about. I mean, just to sort of take a Scottish focus for a second, we've got a question in there about that, Andrew, maybe you could pick up on this, but why fintechs should set up in Scotland when, you know, there's perhaps large amounts of ESG funding in the US, or, you know, bigger markets in the EU. You know, what do you see as the attraction from a Scotland point of view?
I think the ecosystem is the main benefit to starting a fintech business within the Scottish market. And Bowhurst, who are independent research group, recently listed Glasgow as number 5 and Edinburgh as number 1 in terms of tech ecosystems outside of London in the UK. And I can't remember the exact numbers, but yeah, and Nicola at FinTech Scotland will have the numbers to hand, I'm sure. But there's a very good ecosystem of tech businesses across Scotland, and a very supportive investor base, particularly, I would say, at the startup phase. I think a lot of challenge that companies face is that they will reach maybe they'll raise from high net worths up to say 2-3 million, and then there's maybe a bit of a gap between the 3 million to the 10 million requirement. So some companies struggle to find investment at that stage, but I don't think that's a uniquely Scottish problem. I think that is that's true of European tech, and then above that 10 million stage, there's a lot more investment as well. But it's actually reaching, say the 10 million ARR mark where you raise that level of money. So yeah, I think Scotland's ecosystem for fintech is very good.
Yeah. Okay. And I suppose just sort of staying with that comparison. I mean, Ewan, there's a question here that might pick up just around the UK's general approach. So maybe not just Scotland, but the whole of the UK's general approach to ESG development. How does that compare to some of the other developed nations? You know, what does that look like? What's our place in that kind of international sphere, and where do you think we place in that?
So I would say we're pretty near the front of innovation and rollout of ESG regulation and legislation. I think, overall you would look at the EU package and say that is more ambitious than what's going on and has moved slightly faster than the UK. But the UK is coming up fast behind. It's playing an important role in international initiatives. One of the things we didn't touch on earlier is the standards that the International Sustainability Standards Board are creating, and these are standards which would sit alongside but separate from international accounting standards. Mm-hmm. And the UK is looking at making those mandatory in the UK, probably again starting with the largest companies and rolling down. That shows quite a level of ambition, and we've seen quite a lot of signposting in recent announcements around what we might expect to see coming on nature-related disclosures and those being built into the ecosystem. So I think there's quite a lot of ambition. One of the kind of differences between the UK approach and the EU approach is the UK's been more focused on the financial consequences for entities of their decisions and how they deal with climate and sustainability issues, whereas the EU has taken more of what's termed a double materiality approach, so looking at the financial implication but also the impact that a business is having on the environment. And it would be interesting to see whether that all begins to move together, particularly as we see large companies subject to both regulatory jurisdictions. But we're up there, but not quite at the forefront.
What's the reason for that divergence out of interest? Why is there a different focus or an additional focus?
I think in the EU, there's been more buy-in to sort of seeing that impact as driving investor choices. And we've taken a more markets-related approach in North America and the UK to this issue. And we've been we latched on to the ISSB, the International Sustainability Standards Board, as creating an international model for people to follow, but that it has always been set up as a financial consequences-based body, and so we've kind of followed that model. So there's different kind of philosophical approaches,
Okay.
I think.
No, that makes sense. That makes sense.
Do you agree with that, Hayden?
I do. I guess we need to flag the Inflation Reduction Act in the US
Yes.
as well as a sort of example of fiscal stimulus, if that's the right word, and tax breaks and incentives to the tune of about 600 billion, I think it is, which has just been brought in. So that is having a marked difference in terms of if you're looking to set somewhere up, you look at the incentives in the US, quite attractive, especially if it's included on that list of activities on the annex to the Act. The Europe has responded as well. I think they saw that the Green Deal, as they call it, which is this regulatory sort of driven approach, is not having the right sort of desired effect or outcomes that they were anticipating in terms of moving capital redeployment towards green activities. So I think they're looking at the US and thinking, right, we need to respond. And they, a few weeks back, sort of outlined how that might look. I think the UK is almost got like a second mover advantage in terms of can step back, see where the pitfalls are, see what works, design a package. The green sort of finance package that came out a couple of weeks back was a little bit underwhelming. So hopefully, I think we're getting to the place now where we can see lessons learned from what works around the world. We've got the right regulatory set up from a financial regulator. The FCA is very engaged, and the Bank of England are at the forefront, definitely in terms of some of the climate requirements. I would say that. So it's starting to come together. Maybe not as quick from a UK perspective as we'd like to be at some points, but the regulatory sort of base is there, I'd say.
Yeah. Okay. Thank you. Now there's quite a popular question on here, so I'll throw this one out to you, and it probably links back to some of the themes that we had in the earlier discussion. But the question is there a risk of perfection being the enemy of the good in ESG? So we've got all these waves of legislation and standards, and does that drive confusion rather than action? Does everyone get a bit paralysed because there's just so much to look at? So who wants to start on that one?
I can take that one. I think certainly I'll take it from a kind of from a business paralysis perspective, and that's the question. Even we get asked at kind of board level is what action do we need to take? What do we need to focus on? And in fact, one of the conversations we were having discussions yesterday with some of the banks in the UK, and if you look at it at the kind of top level, again to this top level of the economy, they're looking for 2,500 data points from all their supply chain, and then you take that down to a micro business that's going, well, I can give you my energy bill. Which is one data point. So it's about trying to find, and that's really what we're very focused on at the moment, is trying to find a common denominator, a good starting point of what data do SMEs particularly need to focus on collecting that's achievable, attainable. They don't need a sustainability officer in order to do it, but allows them to be able to track that in a transparent and validated way that they can then gain access to additional finance and the green financing that's coming down from these green deals. We don't want the data points to become the enemy, the perfection to become the enemy. So I spend a lot of time and a lot of my day discussing the data points of the risk teams within banks and how does that marry on to their value chain and what the value chain actually can provide to them. So that's my kind of agenda. The top of my agenda is to try and make it easier, so that we can make it less perfect, if that makes any sense.
Yeah, no, it does make sense. Yeah, but to get something done.
Yeah, maybe a bit of guidance from my perspective is that sitting there doing nothing is not really an option. So firms need to respond. How they respond is obviously going to differ, but typically, in my experience, it comes down to a few core factors in terms of in terms of that response, and it's around people, policy, process, and products. And so you pretty much need to sort of, from a people perspective, understand, well, firstly, the sort of at board level needs to integrate climate, ESG, sustainability, and it needs to have some form of sort of capacity there, or at least understanding of at the highest level how the firm is potentially going to respond to this. And also from a people perspective, understanding external stakeholders as well. I mentioned that in terms of what they're looking for from their expectations. Policy, it's good to have some form of sustainability, ESG policy, set some ambitions, set some commitments, goals, targets, and setting out roughly how you're going to sort of match that. It should be robust, it should be science-based where possible. In terms of process, again, it doesn't need to be too complex, but having some form of integrated governance is absolutely critical to sort of operationalise all this stuff. And however small a firm is, they will still have processes. Ideally, they should be documented, this, that, and the other. But that is a common theme. Also around sort of integration and metrics and data as well around that. And then products, which is the final one. Have some, think about, the opportunity, because as I mentioned earlier, there's a huge scope for engagement in this market and supporting around innovation and development, new products and services.
Yeah, absolutely. Ewan, anything you wanted to add to that just before we? I guess we're probably getting towards the end of the session, and thanks to everyone who's been putting questions in. I'll just try and pick up a couple of them quickly before we start to move on. There's one question, Andrew. The question is, do you think that by 2030 equity investment is going to be regulated to comply with ESG matters, and how would investors see that?
I don't know the answer to that. I'll probably defer to Hayden and you. There's certainly an expectation that we can, that we meet ESG requirements. But is that mandatory and regulatory? I don't think it is at the moment. I'm not sure. It sounds like the way that the regulator is evolving, mm-hmm. Then it could well be that that it does become slightly more officious, and we have to comply with that.
Yeah.
Certainly the sort of medium to larger asset managers that are already captured by the regulation from the FCA, and then anyone that's captured under the Sustainable Finance Disclosure Regs are already sort of regulated from that perspective as well.
Yeah, absolutely. And I mean, just in terms of, Andrew, some of the businesses that you're looking at and you're seeing, any interesting trends just in terms of what you're seeing fintechs embrace at the moment?
Yes, a couple of, so we've got 3 fintech investments, and 2 of them are, one which is based in Glasgow, I should mention, a business called AutoRec that does reconciliation software for asset managers and banks, and has some global globally leading asset managers as customers. So two of the 3 fintechs are both B Corp certified at the moment. So that feels like a trend, certainly within software companies. And B Corp is all about putting the society first. It's like a gold standard for ESG, basically. So you commit not only to boosting profit for the shareholders, but you want the business to be a force for good in the world. And it's done to such an extent that you change the articles of association of the business, and it's an incredibly rigorous process to go through in order to become B Corp certified. And we're seeing that as beneficial for our 2 fintechs that have the accreditation. I think there's 2 or 3 others within the portfolio that are trying to get the accreditation at the moment. And I suppose it's good in and of itself, because it's great to be investing in businesses that are so conscious about the environment that they're operating in, and have a higher purpose than just profitability. And it's also good for the culture within those organisations, because people are quite proud to work within B Corps. And we find that helps with retaining talent and growing the business as well. So B Corp
Yeah.
is a really interesting
That's
one.
interesting. That's
Yeah.
what was going through my mind as you were saying that.
Mm.
We talk a lot about how challenging it is to attract and retain talent. It's
Yeah.
interesting to see how some of these initiatives will contribute to that positively, I'm sure. Yeah. And Ewan, just from your perspective, interested, do you see any other trends and areas where fintech businesses that are looking to attract investment that they're embracing in this space?
Well, I think we've talked a lot about the climate issues, but I think looking at some of the social areas, particularly in light of that regulation from Europe that I've talked about, it's looking at things like, working conditions having to be reported on, equality, non-discrimination, human rights compliance across global supply chains, looking at the impact on human health. ISSB is also going to ask people to look at the impact that businesses have on communities. So again, I think there are lots of opportunities there about thinking about quite different types of data and how you might compare things that are quite qualitative in nature. And that could be interesting as well.
And we keep the word data keeps coming up here. So again, the opportunity for fintechs potentially to support with the collation of that kind of data as we go.
Very much
And
so.
you've alluded to this, Hayden, but I think I don't know if the panel can necessarily give specifics here, but one of the questions that was asked was how can AI help with ESG developments? Let's assume it can. Any thoughts on how?
Yes, I can. Well, I don't know the mechanics of it, but certainly in terms of making sense of unstructured data, developing those interdependencies between potentially sort of unrelated sets of data as well. I think once we open it up beyond carbon, as I mentioned, into things like biodiversity, resource use, they're interrelated in the natural environment. The data comes in sort of discrete packages, but obviously to like I say, to make any sense of that and to make informed investment decisions or informed business decisions aligned with your net zero strategy or whatever, you need to make sense of this data. And I think, as I mentioned earlier, this is unstructured, quite complex data, it can be. So I think AI potentially has a role in terms of, machine learning making sense of it, AI making sense of some of the trends, some of the synergies, some of the gaps, the risks and the opportunities. So someone out there can sort of, apply a really sort of clever algorithm or an off-the-shelf AI package to some of this sustainability data. Because as I mentioned, sustainability itself, it's not broken down into E, S and G. Sustainability is the interrelationship between environmental, social and economic, right? So it's bringing in economic data and financial data into this as well. TCFD we mentioned, it's not climate disclosures, it's climate financial disclosures basically, climate-related financial disclosures with the emphasis on financial. So it's bringing all this together, environmental, social and economic. Somewhere in the middle is the answer. And I think AI has got a role somewhere to work all that out.
Yeah, absolutely. As it does in many areas. Thank you. I was.
We're just going to add one thing.
Well, add one thing, and then I'll let these people get some refreshments.
How can AI help us stop doing things that we do at the moment, which are very energy intensive or resource intensive? And I think, as well as what it might do directly for the question, it's how we could stop doing other things with AI, and I think that's a really interesting question.
Yeah, how we deploy it in that sense. Yeah, absolutely. Okay, well, thank you very much, all of you. I'm just very much appreciative of all the questions that have been coming through in the Slido, and I'm sorry I didn't manage to get to all of them. Just the person who was asking about advice on establishing a sustainability policy, see the Pinsent Masons team afterwards. We'd be delighted to chat to you about that. But thanks to all of you for participating in the Slido, and thank you very much to the panel tonight for all of your insights into this topic. Obviously, a huge topic, lots to cover in a relatively short period of time. But hopefully, we've covered a range of issues for you and given you food for thought. We'll obviously all be around afterwards if there's areas that you'd like to pick up with us. But for now, if you just join me in thanking the panel.